Okay, so take a look at page 474. Lower of cost or market. They have the ceiling and floor idea. Is that perfectly clear to you guys? Ceiling and floor? It's really pretty straightforward. I don't know why we use the term ceiling and floor. The ceiling is the one you can't go above, the floor is the one you can't go below, but when you look at the definitions, it'd be impossible to go above or below. What are we doing here? Lower of cost or market. We are trying to estimate what? Inventory value. Yeah, it's lower of cost or market, right? So cost, we already know what it is. We count the inventory and we value it at cost, right? What do we do for market? We need an estimate of market. We don't really know what market is. There's different ways you can think about market. What we're going to do is we're going to use 3 different estimates, and we are going to take the one that is in the middle. That's it. Okay? So is that better than just using one estimate? I guess. Right? We could take the average of the 3, but we don't. Right? We take the one that's in the middle. However it falls. That makes sense? So, but it's okay. It's not bad. Okay. And what are the 3 methods? Net realizable value, right? Yeah, what's net realizable value? It's your sales price less direct cost of disposal. Sales commission maybe, right? Delivery costs, if you pay it. And direct cost of disposal. Okay, got the idea? So that's net realizable value. And then what's another one? What's that? Well, relative sales value, though, these are estimates of the relative sales value. So, we have net realizable value. There's one there. Where did that go? Net realizable value, which you just said is what? Sales price minus selling costs. Cost of disposal. Okay? What's the next one? Right there on page 475.
Realized value less your normal profit.
Like a normal gross profit, right? Wait a minute. Net realizable value. Oh, well, you know what? Net realizable value minus normal profit is what? It's got to be less than net realizable value if you have a normal profit. So, duh. They're in order, aren't they? Right? Okay? So, yeah. You'll never go above that one. Yeah. You'll never go below that one. Because you're always going to take the one that's in the middle, right? No kidding. So that's where they give ceiling and floor. You can ignore that. Ceiling and floor doesn't really mean much, does it? But people use it for a long time. So fine. They can call it that if they want. Rid of that. It's not fine. Okay. So what is net realizable value less normal profit approximate? Normal what? Normal sales price less normal profit must be normal what? You guys are aware that sales less something is gross profit? Cost of goods sold. Yeah, you're getting an estimate of cost of goods sold. What does inventory become when you sell it? Cost of goods sold. So this one's kind of an estimate of cost of goods sold, isn't it? Right? This is sort of based on your selling price, but less any direct selling costs. So you don't want to go above that. You don't want to go below normal cost of goods sold. Got it? Big deal. Okay, and then what's in the middle? Well, not in the middle necessarily. What's the other one? What's the third one? What do they say the other one might be? Anybody see one? What else do they use?
Replacement cost.
Replacement cost. Yeah, so it's a measure of market value too, right? All these are supposed to be sort of replacement cost. So you look at what would it cost me to buy it now? Well, that might be more, I guess. So it could be less than your original cost, right? But, you know, usually more than inflation. And what are we going to do? Of those 3, these are all estimates of market value. Of these 3, what are we going to do? Take the one that is in the middle. That's it. That's all you have to do. Now be careful. Do those first and then compare that to cost. So whichever one you take that's in the middle of those 3, right? You compare it to the cost, and if the cost is lower, what's the deal? It's lower of cost or market. You use the cost. What if your estimate of market, based whichever one of those three you pick, what if that one is lower than the cost? What are you going to do? Use it. And what's our reasoning on this thing? We are what? Conservative, right? We're being conservative in our estimate. Do we ever use the higher of cost or market? No. We use the lower of cost or market. We're being conservative. We're writing down the inventory, right? Okay, and you might have an allowance to reduce to market value, huh? Okay, I set one up. Okay, so let's try a problem that does. This is just so easy. You're gonna like this stuff. This one's good. So let's look at problem, exercise. Let's try exercise 9.2, okay? Do 9.2. Let's give it a shot. What are we going to do here? Exercise 9-2. What do I want to know? I want to know what's lower, cost or market. So let's separate them out. Let's do a few of these items. Let's do D, okay? Item D, okay? I'd like to know the cost, and then I'm going to separate that from my three market measures. What are my three market measures going to be? Net realizable value, net realizable value minus normal profit, and replacement. So here's how you might go. It's not bad at all. Tell me what you do for each of these. Item D. What's the cost? Yeah, you just read it, big deal. $75. What's the net realizable value? Sales price minus estimated selling expenses, disposal costs. So what's that? 120 less 30 is what? Okay. What's normal profit? 20. So guess what net realizable value minus normal profit is? 7. I can even do this. What's replacement? Okay, now what do I want to do? I know the three of them. I got my three independent measures, sort of, right? Estimates of market value. What's the one that's in the middle? All right, so what is the one we're going to use to value our inventory? We'll take it times the quantity we have for that inventory. Which one will it be? Cost, of course, because it is lower. That's it, okay? So you could have a scenario where any of these are in the middle, right? Right? You could. Okay. So let's try another one. Let's do E. What does E give you? What's cost? What's net realizable value? Sales price is 110 less estimated selling of 30. What is it? 80. It's 80 also. Less normal profit. What's normal profit? So what do we have? 60. And what's replacement? 72. So they're trying to show you there could be, right, different ones in the middle, huh? Okay, so what are you going to do? Keep them separate, the cost and the markets. The biggest mistake students make, can you tell by my explaining this? They blend this in with the other three and they don't have a clue what to do. How do you get one in the middle if there's four of them? Oh, brain explodes. Okay, it's not a big deal here, you guys. Which one of those three markets are in the middle? I think 72 is between 80 and 60. I can even do it. Okay, now what are we going to do? We're going to compare this 72 to the cost of 80, and what are you going to do? Take the one that is lower. So 72 times whatever your quantity is, that's what you have. Make sense? Okay. Let's do another one. What's that? Selling price is 95. Oh, cost is 80 again, is it? That there. Selling price is 95. What do you want to take away from that? 30, right? Selling cost, what do you have? 65. Did I do it right? Then take away your normal profit of 20, what do you get? 45. What's the replacement cost? 7. Which one's in the middle? 65. Isn't it cool? They're showing us they could all be in the middle. That's really nice one. Okay, so what are we going to do? Is 65 lower or is 80 lower? Cost compared to market. I think 65 is lower. I'd use that one. Okay? Let's do G. So, cost is what? 80, bunch of them are 80. All right, sales price is 90, less what? Selling expenses are 25, what do you get? Is that 65? Okay. Take away your normal profit of 20, what do you have? 45, and what's the replacement cost? 30. What is it, 55?
Yeah. Ran out of beef.
This one?
No, that one.
First one? Sales price is 90,
90 minus 25.
selling expenses is 25,
That's 65.
65.
Oh, I got 35 on my book here.
Oh, just a second, that's 65, and then what would we subtract from that? Normal profit of 20, and we get 45, right, for G, right? Okay, and then what's replacement? Replacement is 30. The answer in the book wrong? Everybody agree with this?
Oh, yeah.
Yeah, yeah, maybe it's a typo.
My book is a bit different. I got 25
Okay, it's wrong. I'm not kidding, unless your problem's different than ours,
Yeah.
somehow, yeah. I think we did it right, don't you guys? Anybody objecting? Did I miss something here? Okay, what do we want to do for the market? Take the one that is in the middle, and guess what? That's less than the cost, so that's the one we'd use. And you can see they have an example here where, you know, it could be different on all. Okay, now what you can do, so big deal. I'll actually give you a question for you to do this. You're welcome. Okay? At least on a quiz, maybe on a quiz and a test. Yeah, maybe even on the final. Okay? You'll see some stuff like this. People use this. Okay? 3 ways you could do this. You could either do it on each individual item like this, right? And so what you're always doing is for every single item that you value in your inventory, you do it for that specific item, huh? Go through this process. Then you multiply those lower cost or market items, right, values, times the quantity, and then you add them all up, huh? You get your total inventory. That's what the inventory would be on the balance sheet, okay? Everybody got it? Okay, lower cost or market. If you want, however, what you could do is you could add them up. You could take the quantity times each one of the costs, right? And then you could add up the total of them. So what I get is I would get a total for cost and a total for market. Ah. And then on the total of the inventory, I compare cost and market. That's the idea? So you do each individual one? You could do the total for the whole inventory. Or you can do it by categories of inventory. Maybe you got different types of products, so you do one group of products, another group of products, another group of products. And you do it for just them, right? Their cost compared to their market in total. Now, think about this, and this is real common on the CPA exam, on my exams. Which one is going to give you a higher or lower estimate for inventory? What happens if you do the inventory as a whole? If you do it by category, it's going to be somewhere in between, right? Somewhere in between the two other ones. So let's do the two outside ones. What if I do every single item? What's going to happen? Every time for that an item market is less than cost, I'm going to use the market on it. I won't get the average amount. I won't get the offset when they're above and when they're below, will I? So what's going to happen is I'm going to get a what? Larger inventory write-down. If market ends up being less than cost, I'm most likely going to get a lower market value. What if I do it on the inventory as a whole? Oh, well, sometimes they'll offset, won't they? Some costs are higher, some costs are lower, some market values are higher, some market values are lower. If you do it for the full inventory, what's going to happen? You'll get a smaller write-down, or maybe not one at all. So either one's acceptable. And you do it by category, somewhere in between. That kind of makes sense, guys? It's offsetting, right? Just offsetting. So make sure you look at a problem where they do that, where their value, right? One of the other ones where they actually value full inventory and compare the three. It's not a very big deal, but there tend to be questions on it, so why not? Okay? It's not a big deal either. It's doing exactly the same thing, though. Everybody get the idea? I would, if I was doing, let's say each of these is just one item. If I was going to do cost, I would add together 75, 80, 80, and 80. Go ahead and do that. Let's do it. Let's pretend this is our whole inventory and we only have one item of each, which is kind of silly. Okay? But let's do that. Let's add all those up. Okay? And then we'll add up all of our market estimates, the ones that we have circled there. What, 80 plus 80 plus 80 plus 75, 315. Okay, so my cost is 315 for my total inventory, assuming I have one of each item. Okay? Real simple assumption. Add together 90, 72, 65, and 45. And what do you get? 272. So my write down would be what? I'd write the inventory down from 315 to 272. Got the idea? 28 plus 15, 43, I guess, huh? Or I'd write my inventory down by that. Now, what if I was doing specific ones, though? Now, what do I get from my inventory? Add 75, right, plus 72, plus 65, plus 45. Now, what value do I have? Right? If this is the one I pick, 72, if I'm doing each individual item, this is the one I'd pick, right, for market if I'm doing each individual item, then this one, and that one. So it's 75 plus 72, you got the idea, plus 65 plus 45. So this is specific, each specific item. 257, which gave me the bigger write-down, of course. When I specifically do it item by item, huh? Because it's got a smaller write-down here, didn't it? We get the idea, I go from 315 down to 257. Be 43 plus 15, 58. Okay? Not a big deal, huh? And we can do it by categories too, split them into categories. It'd come up somewhere in between if we did that. All right, so that's lower of cost or market. You're welcome. There's some easy stuff in the chapter like that. Ceiling and floor. Okay. Let's see. And that individual major categories of total inventory is over on page 477. They show you a nice little example, simple example. Okay? Do them by categories. Frozen and canned, I guess, the categories. All right. Over on page 478, what do you do if you do want to write down the inventory? Okay, different ways you could do this. If the write down is not material, what might I do? Debit cost of goods sold, credit inventory. And now using lower cost of market. That's the first entry they show you there. The cost of goods sold method. If it's real material, you might not want to do that. You might want to set up a loss instead so people can see that you have a loss due to the decline in the inventory value. And that's separate from your cost of goods sold. That makes sense? You can put that in the non-operating category, I guess, if you want, right? Kind of non-operating revenues and expenses, gains and losses. And that other category down below, right, guys? Still before tax, right? Down below gross profit, down below operating income even. Or you might just put the loss line right next to cost of goods sold, but people can see that it's part of cost of goods sold, but it's due to a decline in inventory. So there they've got a debit loss due to decline in inventory and credit inventory, right? Get the idea? Over on page 479, there's another thing you could do. Instead of actually reducing the inventory, you could keep your inventory at cost, right? And record an allowance. And we've used allowances for all kinds of things, right? Allowance for doubtful accounts, allowance for returns and allowances. Remember we talked about it? Right? So it's the same type of thing, okay? So we've got an allowance here. What would you do? You debit the loss and credit the allowance. And theoretically, you could debit cost of goods sold and credit the allowance too. You could do it that way, but that's usually when it's immaterial anyway, so you'd probably just run it through the inventory if you did that anyway, right? So then what you're doing is you're showing your inventory at cost in your balance sheet, and you've got a balance in the allowance account that you subtract from that. What kind of account do you think the allowance is, everybody? Contra asset. That's it. It's got a credit balance. It's just another contra asset. It's no big deal. Okay? Got the idea? So companies can do it either way. So if they ask you to use an allowance, big deal, huh? So I could show on the income statement the loss separately from the cost of goods sold. And on the balance sheet, I could show the allowance separate from the inventory, right? You show the inventory at cost less the allowances. Obviously, inventory lower cost or market, right? Everybody got it? Not a big biggie? Okay. There's another thing. Okay. How about over on, multiple periods, I should mention that before you. Okay. Every single time we have an allowance, right? That allowance to adjust to LIFO that we had in the last chapter, right? There's another one, right? Allowance for that. Every time we have one of these allowance accounts, every time we have a contract asset account in general, or really any asset liability or equity account, and then we've got revenue and expense accounts, right? Gains and losses. What's a big difference between all those accounts in the balance sheet and those accounts in the income statement? What's a huge difference? What happens at the end of the year?
Income statement accounts get closed.
That's it. The income statement accounts get closed and you start over. So what's going to happen to the loss on the write-down in this case? It gets closed and zero. You start over. What's going to happen to the allowance to reduce the inventory to lower cost of market? It stays there, and it'll be there in the next year. So if you get a problem, on one of my quizzes, test or final, you get a problem on the CPA exam, or you get a problem in real life out there, right? And you're trying to do this year, and they used the allowance method last year, and the year before, and the year before. Your task is to do what? Adjust the allowance from where it is to where you want it to be, and what's the difference going to go to? If you want the allowance to be bigger, you credit the allowance, what do you debit? Loss. That's the loss for that year. It's the increase in the allowance is the loss for that year, right? What if you want the allowance to go down? You got to debit the allowance, don't you? And what do you credit, everybody? Recovery of loss, right? Because you took a loss in prior periods, and now it's done. That makes sense? So you'll adjust the allowance from where it is to where you want it to be. Usually you'll be increasing the allowance, I suppose, if the inventory is growing, right? Okay? And the market price isn't recovering. But if the market price starts recovering, right, you might need to reduce that allowance. It's a contra asset. How do you reduce it? Contra asset. How do you reduce it, guys? Come on. It's late in the semester. It's later in the day. You've been thinking all day. It really sucks having to think. Come on. You're going to debit an allowance to reduce it, aren't you? Debit a contra asset to reduce it. And what would you credit? Well, you credit the loss, right? Except the loss doesn't exist anymore. That was last year. You close it, so it's going to be recovery of loss. That's it. Yeah. So it'll be like a gain. Okay? Everybody got the idea?
Either one. Doesn't matter. Like recovery.
Well, if there's no balance in the loss, if the loss is zero, you wouldn't want to credit it. You'd have a credit balance and loss. So we call it recovery. If you were doing it quarterly or something, though, and there's a balance in the loss, yeah, you just credit the loss. As long as you still have a debit in it, you're just fine. Okay, everybody got the idea? Okay. These are not big, just you need to think about them. Read through it too, of course, if you haven't already. On page 481. By the way, I know you guys did really crummy on this quiz. Partly it was because there was some interesting little twists and some easy questions there. And we'll go through them, it'll be fun. Okay, we'll get ready for the test. But also you kind of backed off because you worked really hard on the test, didn't you? And you got it all together. I'm going to improve my grade, and you backed off. Stay in it now, okay? Half the points coming, right? So stay in it, no days off. Stop taking days off. Don't do it. That'll make a huge difference in your grade. Hang in there, hang in there, hang in there. And just forget about what your quiz score was next. Right? Done. So it doesn't make any difference. Go for it like you did on the last test. Okay, so go for it on this next quiz, on the test, and on the final. Okay, your head in there, go for it. Okay, easy to do in a class like this. It's just too much. The bottom of page 481, valuation of net realizable value. At net realizable value. This is an exception. Under limited circumstances, support exists for recording inventory at net realizable value, even if that is above cost. GAAP permits this exception to, I'm at the top of page 42, bottom of page 41, top of page 42 now. Okay? GAAP permits this exception to the normal recognition rule under the following conditions. So look at this. When there is a controlled market with quoted prices applicable to all quantities. agricultural commodities, right? I got apples. I know what I'm going to sell the apples for, okay? So now what it's going to, or I think I know, I got close. I can value it net realizable value, okay? As one. It doesn't have to be agriculture, but mining too. When no significant cost of disposal are involved, okay? So mostly it's ready to go. Right? You're done producing the product, in other words. For example, mining companies ordinarily report inventories of certain minerals, rare materials, especially at selling prices, because there is often a controlled market without significant cost of disposal. Similar treatment is given to agricultural products that are immediately marketable at quoted prices. Okay? A third reason for allowing valuation at net realizable value is that sometimes it is too difficult to obtain the cost figures. We don't know what they cost us. Apples growing on the tree, what do they cost us? Oh man, even after they're harvested, what do they cost us? It's really tough. So we'll use a measure based on sales price, okay? So that's a really good one to know. Okay, let's take a look on page 482, another real easy one. Valuation using relative sales values. This is just not a big deal. It's just an allocation problem, right? What'd you do in 102, the big allocation of costs? Process cost accounting. Remember the allocation of costs you had to do across across the processes? It's just like that. It's going to be, you're going to take a pool of dollars and split them up, right? How do you want to apportion? And we don't just do this for something like inventory. We do it for a market basket purchase of building equipment and land. We pay one price. Let's say we pay $10 million for building equipment and land. We know how much we paid, but we don't know how much was for each one. And does it make any difference which one we put the values on? Oh yeah, you're going to depreciate equipment and building. You're never going to appreciate land, right? You want to be fairly careful with this thing. Also, on equipment, you're going to depreciate it fast. On building, you're going to depreciate it slow. Might people want to cheat to get either more depreciation expense or less? Yeah, okay. So what we do is we apportion it based often on relative market values. So we get some sort of an appraisal of each one, some sort of an estimate of the value of each one of the pieces. But you know what? That total value might be more than we paid. Often is, because we bought a market purchase. So we'll use the percentage of each, right, to allocate the total cost. And that's exactly what's happening here. Take a look at their example. Let's just use their little example. Here they bought a piece of land, right? They paid $1 million for a piece of land. They are going to sell the land for $2.5 million in total. At the bottom of page 482. You see that? Okay. The way they know they're going to sell it for $2.5 million is this. They know they paid $1 million for it. Everybody agree with that part? They know they paid $1 million. That one you know. Okay. They think there are going to be 100 lots that they sell for $10,000. Those are up on the top of the hill, right? You got the idea? They're going to have a view or something. Okay. So this is a long time ago. Make it a $100,000 lot. Okay. All right. So they got 100 that are $10,000. I think you buy lots for that. But anyway, they got 100 lots for $10,000. And then they got 100 that they're only going to get $6,000 for. At a zero, they're $60,000 lots. Okay? And then they have the crumb acres, right? Nobody's really going to want, but they've got 200 of those. They're in the bottom left there, you know. Going to look up at all the rich people. Okay, anyway. Right? Maybe they'll flood. Okay, no, hold on. Okay, anyway, so they're 45,000 each. Got the idea? 4,500. Example here. So half of that. So what they did was they took 10,000 times 100 and got $1 million. They took 6,000 times 100 and got 600,000. They took 4,500 times 200 and they got 900,000. And they think they're going to sell all the lots for 2.5 million. Okay? So what you can do then is determine, well, what portion of our sales, what's the million divided by the 2.5 million total sales price? What percentage is that? 40%, right? That's the way I'd do it. I'd make it 40%. 100 over 250 is 40%, right? 40% of the total cost is going to be allocated to those lots. So I'm going to take 40% of the million. See the last column there? I'm going to take 40% of the million and I get 400,000, okay? The B-type lots, I'm gonna sell them all for 600,000. 600,000 divided by 2.5 million, how much is that? 24%? So 24%, I can't really do that math, I looked at the last column. Okay, so 24% times a million is 240, huh? The 900 divided by 2.5 million is 36%. Take that times a million is 360. So now you know what the total cost is, you think. You've apportioned the cost, right? For each one of the lots, each one of the types of lots. How do we find out what each lot cost us? Well, you know, you got 400,000 going on lot A, and there's 100 of them. Divide 100 in there, you got 4,000. Got it? So I might give you a problem like this too. Got to hope for that one, huh? Okay. And then the 240,000 for lot B is 100 lots also, so that's 2,400 each. And then on the last one, lot C, there's 200 there, 360,000 total, and those lots cost 1,008. What's going to happen is we'll have the same gross profit percentage across all the lots, right? Because we apportion the cost based on the sales price. Okay? And we're just guessing. We don't know because we bought all the lots together, right? You'll put in all the costs of developing the property, leveling things off, the streets, the sewers, everything you had to pay for, all the electrical, right? Cable and everything that you install. Everybody got the idea on this thing? Right? So you put all the costs together. We know what it all costs us. We just don't know which lot to put it on. So we apportion it. Okay? All right. So somebody tell me what the gross profit is going to be on lot B's. If I ask a question like that.
That should be like,
What's gross profit, everybody?
it's sales price minus cost.
Sales price minus cost of goods sold is gross profit. Okay.
So that's
Lot B's, each one of them.
6,000 minus.
6,000 that we're selling them for minus $2,400 cost. Each one of them is going to generate gross profit of 3,600. So you could do any of them, couldn't you? And so if we said we sold so many of them, you could figure out what the sales were, and the cost of goods sold were, and the gross profits, right? There are a few possibilities back here. Okay, let's talk about something that I think is more interesting. On page 483, purchase commitments. This one is really cool. This is so different. Do you record inventory before you get it? Before you receive? The answer to that is no, of course. We haven't received it, we don't have the inventory, right? Title has, well, yeah, FOB shipping point, good man. Yeah, but we've effectively received it when they put it on the truck, it's ours, so you're right. Okay. But, you know, until we have title to it, until we have title to it, we wouldn't adjust its value, would we? Well, this is a weird one. I have a purchase commitment. I haven't recorded the purchase commitment. That means I have a purchase order outstanding, right? I placed a purchase order with them. I have a contract with them to buy inventory, right, from my supplier. What do I record because I have a purchase commitment? Nothing. Continue debit inventory they're going to give me later, and credit payable I'm going to have later. And it doesn't mean anything, right? You wouldn't do that. But what if I commit to buying it? For say, I don't know, it's gypsum, and I'm paying $50 a ton. I have no idea what gypsum costs now, but I'm paying $50 a ton for the gypsum. And before they deliver it, the price drops to 47. And I've got 1,000 tons. So I'm going to give them 50,000 for something that is now worth 47,000. Economically, I just lost $3,000. Right? Because I have a purchase commitment. Now, what do I want to do? I think I had to tell my shareholders, whoever's using the financial statements, my financial statement users, what? That I just lost $3,000, right? It's like writing down inventory you don't have yet. Everybody got the idea on this thing? It's really kind of cool. It's really different. You won't write it up, okay? I mean, don't write it up, because it's always lower cost per market, right? So that's why it's in the inventory chapter. It's inventory we don't have yet, I guess, is the way you could look at it. So take a look at the example. Kind of cool. So they have a commitment to buy this stuff for $10 million, I guess, and the price drops to $7 million in the top of page 484. Okay? So forest products company like Boise Cascade, Georgia Pacific Warehousing, right? They have a commitment to buy, oh man, St. Regis. Okay, the 2015 at a price of 10 million, and then the bottom falls out on timber cutting rights, and so it's down to 7 million at the end of the year, and they're going to do a financial statement. So next year in 2015, I'm going to give them 10 million. They're going to deliver in 2015. I'm at the end of 2014. What do I want to show? A loss. So that makes sense, right? So it's an unrealized holding gain or loss. The first entry on 44 there. Unrealized holding gain or loss on purchase commitments. Right? That's an unrealized holding loss, obviously, right? Okay. I don't know if you need to put the word gain in it, although we might recover the gain. We might recover the loss later. Okay, we could. And then I credit an estimated liability on purchase commitments. So where's that going to, where are these accounts going to go? Where are you going to put the unrealized holding loss? It's unrealized because no cash change tax yet, right? But we still think it's a real loss. So where are we going to put it? It's unrealized, but we're going to recognize it on the income statement. That's going to go on the income statement, okay? Down in other, usually non-operating stuff, other gains and losses. Is that the idea? So it's an unrealized holding loss. Where are you going to put the estimated liability on purchase commitments? Under the liabilities, current liability in this case, right? Does that make sense, everybody? I don't really owe them $3,000, but I got to credit something. Okay? Because I want to debit that loss. Now, what if it recovers? And if it recovers, we can reduce the loss. But only to the extent that we recorded a loss in the first place. So how much? If it recovers all the way to the 10, how much of the loss can I recover? 3. What if it only recovers to, say, 8? I can recover 1. You got the idea of it? Okay. So first they showed the loss. Let's write it down. Unrealized loss on purchase commitments. Okay? They went with $3 million. Okay? And they credit estimated liability, because I don't really know what the liability is, on purchase commitments, $3 million. That's what they showed you the first entry on page 484. Okay, so then later, let's say it comes in and it's actually worth $7 million when it shows up, right? Still worth $7 million. What am I going to do? I'm going to debit the inventory. By the way, which method are they using if they debit inventory? They say purchase is an inventory. What method am I using if I debit purchases? Let's do that one first. What are the two methods? Periodic and perpetual, you bet. Okay? So if they debit inventory, what do they do? Why? They're keeping track of how much inventory they have all the time. They're using what method? Perpetual. You guys screwed this up on the quiz, didn't you? I asked you to do net, and a bunch of you did gross, right, on the purchases. And I said that it was periodic, and a whole bunch of you debited inventory for the gross purchase price. When it said periodic and net, if you'd have just relaxed, it would have just fallen out for you. Oh, a couple people got it. Okay. Anyway, take a look at those problems. You'll be amazed. They weren't as hard as you thought. Okay. So if I'm perpetual, it'd be debit inventory. What if I'm periodic? Debit what? Purchase. So, that's the difference, huh? Okay, so if I buy this inventory, let's say I'm doing perpetual. If I buy this inventory and it's still worth $7 million, I put the $7 million in there. Make sense? And then what would I credit? What am I going to pay them? Either accounts payable if I'm going to pay later, or cash if I'm going to pay now. Let's say I pay now. How much would it be? You owe them $10 million. So that's it, right? Either cash or accounts payable, depending on whether or not I pay them. Okay? And then what's this $3 million going to be? That estimated liability goes away. See it? Get rid of that. On purchase commitments. Got it, guys? Okay. Let's say I buy it, and instead it's recovered to, let's make it $8 million. Okay? It recovers to $8 million when I buy it. Now what do you want to do? Yeah, but the inventory for how much? It's gone up to 8 million, right? This isn't the next year, right? I closed in between, right? When I closed this unrealized loss. It's closed, okay? Now what? I have not done this one, right? Because it's a different scenario. I got the 8 million worth of inventory. How much am I going to pay him? 10 million. How much do you want to take out of the estimated liability? Not 2. I fulfilled the purchase commitment. I bought it. How much do I have to take out of it? But you guys, you got 3 in there. Come on, the deal's done. What do you need to do? It's like an allowance for doubtful accounts. You collected the receivable. You don't need the allowance anymore, do you? Oh. An unrealized gain or loss on available for sale securities. Sell them all. You don't need the allowance anymore, do you? Okay? You don't need the allowance anymore. You got rid of all of it. So what's going to happen to that estimated liability? Of course, it's all going to go away. So somebody tell me what the 1 million credit is. Ah, there's more. What is it? Recovery of loss. You got it. We're recovering this unrealized gain. So that's why they said unrealized gain or loss. This is an unrealized gain. Got it? So this would be an unrealized gain. If we already closed this one, right? It'd be an unrealized gain. If it's within the same year, you could just go against that loss, reduce it, right? Unrealized. This time it'd be a gain on purchase commitments. But you can only have a gain to the extent of what? The loss you recognize in the purchase commitment. You can't have a profit. You can't, let's say the inventory is worth 12 million when they deliver it, and you're only paying 10. Can you debit inventory 12, credit cash 10, and credit gain on buying inventory or something at 2? No. What do you have to do? You have to wait until you sell it. And when you sell it, you might have a higher sales price, right? And have a gain that way. That makes sense? Okay. And more gross profit, I'm sorry. Okay, let's do another easy one. That one's not real easy, but everybody got the idea of this? Just odds and ends here before we get into the real meat of the chapter. The gross profit method of estimating inventory. This one I just don't understand why they do it the way they do. Just seems like they take an extra step. But there are a couple things that I want you to get down here. It's pretty straightforward, but what do we mean when we're talking about markup or margin? They say a markup on retail and a markup on cost on page 486. What is this? Sales price. Let's say it's $100. Cost of goods sold, the cost, is $60. Gross profit, of course, is $40. Okay, tell me what the gross profit margin is here. What's the margin? In my little simple example, what would you do?
Gross profit over sales price.
100 into 40 is, well, sales price less the cost of goods sold. It's the gross profit amount. But what's the percentage? 40%. It's just this, right? You have 40 divided by the 100 is 40%. The 100 is 100% of itself, right? 60 divided by 100 is 60%. It's kind of like a big deal, right? Okay? But that's how you do it, right? This is a gross profit percentage or a gross margin. Okay? Percentage. What is the markup here? Well, you know what? The markup is still $40. But I am going to calculate the markup. Okay? What I want is markup. Okay? Whole different animal. Okay? The markup percentage is based on what? The relationship between cost of goods sold and the gross profit. Oh, I have $60 cost. I marked it up $40. What's that percentage, guys? I make the cost 100% of itself. 40 divided by the 60 is how much? 66 and 2/3%. isn't it? 40 divided by 60, okay? And sales price is 166 and 2/3% of the cost, okay? Now the problem with markup is, people will say the markup is 66 and 2/3%, or they'll say the markup is 166 and 2/3%, and not tell you how they calculate it. Marketing people use markup. Accountants and finance people typically use margin. Like we're from different planets when we're talking about this stuff. So when they say a percent, margin, or markup, what do you need to do? Ask how they calculate it. What do you mean by margin? If they say, well, it's the percent the gross profit is the sales price, of course, and you say, yeah, I agree, it's cool. If they say it's the amount, the percent I added to cost, whoa, that's not margin, that's markup, okay? And if they, what if they say it's a 300% markup? What could a 300% markup be? Two different things. Let's do a 300% markup. Sales price, cost, gross profit. If this is 100, give me a 300% markup. Give me two different ones. What would be 300?
Gross profit.
This could be,
Gross profit.
this could be 300, right? Which would make this 400, right? Is that right? Or this could be 100, and this could be 300, which makes this 200. What do you mean? What do you mean? What did I mark up? I mark up the sales price, or is the markup the amount I added to it? Okay? Now the thing about this that's kind of cool though, is when you're calculating, take a look on page 486, when you're calculating any of these, the relationships stay constant between markup and margin, okay? So let's say that I have a sales price of 100, cost is 80, gross profit, of course, is 20. Tell me what the margin is and what the markup is. What's the margin? If you knew it was a 20% margin, could you convert it into markup? They'll ask you to do that. Or if you knew the markup, could you convert it into margin? Well, nothing to it, right? I know this is 20% of that number. What does that make this number? 80% of it, right? Everybody agree? And then what's the relationship here? What's that one? That one is 20 divided by 80 is 25%. A 25% markup is always a 20% margin and vice versa. It's just math. Everybody good with this stuff? Price, cost, gross profit. Let's do 150 and 50. What's that? Margin? Obviously 50%. And of course you don't have to have numbers be even like this. What's the markup? It's not intuitive, is it? 100% markup. Okay? Let's do another one. Sales price, cost, gross profit. Let's say I do have say I have 100 here, 200 here, 300 here. This is where people start playing games with numbers. When somebody says the markup is more than 100% in the general press, business press, I think people think that somehow they make a bigger profit than the sales price. That's virtually impossible, right? This is a nice markup, nice margin. What's the margin? What's the margin, you guys? 200 divided by 300, what is it? 66 and 2/3%. We're real happy, right, with a margin like that. We'd be real happy with that. What's the markup look like, though? What would it be, markup? What do we do? Either go this way or go this way. It's either 200%, right? You double the price, which is most commonly used, or it's 300% if you look at the sales price. Got the idea? 100 divided into 3 is 300, 100 divided into 2 is 200. So, if they say it's 200% markup, these would be markups. Well, fine, that's a 67% margin, right?
So we have two methods of calculating markup.
Yeah. The author is always using markup, cost and gross profit.
Yeah.
But my point is, marketing folks sometimes use sales price relative to cost. Okay? So you need to ask how they calculate it. That's all you got to do. Otherwise, it's obviously you're off by 100% otherwise, right? Okay. So, before you do some computations or actually price products or something, make sure you understand how they're doing it. Okay? And marketing people are quite comfortable with either one. They use both kind of interchangeably. So, okay. All right. Everybody good? Not a big deal on this one either? All right. How about the gross profit method of estimating inventory? Top of page 486 there. Okay, this is a situation where I'm doing an interim financial statement. I don't want to count my inventory. Okay? What if I'm doing monthly financial statements? I don't want to count the inventory every time. Could I estimate what my inventory is? Yes. And if you know what you start with, your beginning inventory, plus you add your purchases to it, do you know what's available? Sure. Everything that's available is either you still have it at the end of the period or you don't, right? You still have it, what do you call it? Inventory in the balance sheet, right? If you don't have it, what do you call it? Cost of goods sold in the income statement, right? So imagine a situation where I did count the inventory at the end of last year, right? I know the beginning inventory. I keep track of all my purchases. By the way, is this a periodic or perpetual system I just described? Periodic. If it's perpetual, I already have an estimate of cost of goods sold. Right? Perpetual? What do you do every time you sell something if it's perpetual? Debit? Cost of goods sold. Credit? Inventory. Don't you always have an estimate of your inventory and your cost of goods sold? Sure you do. So if you're periodic, what happens though? My beginning inventory is still recorded, isn't it? Until the end of the year when I count again, or whenever I count, right? Say I'm doing it once a year. Until the end of the year. Everybody got the idea on that? And all my purchases are in the purchases account. What about what I sold? Well, I didn't record anything, right? You see the difference between periodic and perpetual? It gradually builds, doesn't it? Gradually get a real grasp of it. Okay? I know I'm really mean to you guys today, especially really to understand things. If you don't really understand, then you won't take it with you. You won't know what you're doing when you go out there. If you just perform for me on a quiz or a test and you don't really know what's going on, so what? You're never going to be a CPA, right? You're never going to be a financial vice president, right? You're not going to get there. You're not going to know where those numbers all came from, okay? So it's really critical as you go. I know what you're doing is you're trying to survive my quizzes and tests and final and get a reasonable grade out of the class, right? That's where we want to go. And I do want you to do that, but what I'm trying to do is make these quizzes, tests, and final in a manner that requires you to know what the hell you're doing. And then I get my way, right? You get your grade, fantastic. I care less what your grade is, right? Although when you're interviewing for jobs, it's nice to be able to tell them you got an A from B plus or something. It's really cool. That's nice, okay? Or at least a C plus, right? You're solid, okay? On your way. But it's not about what the grade is, really. It's about what you're doing, isn't it? So, right, hang on to that when you're doing all this stuff. It goes away, doesn't it? It's got I want to survive, I want to survive. So, I don't know, you feel kind of the same way at work sometimes, too, so it's all right. I want to survive this engagement and get on to the next one. Okay, so how do they do this? I don't know. Oh, it could be that. It could be I'm estimating, and I haven't counted the inventory. What's the other one it could be? The inventory got stolen, it got burned up, got lost, real common. These are real common questions, so I'll give you a few of these things. And they're really simple. Okay, what we do is we look at what the relationship is between our sales price and our cost, okay? We get our normal gross profit percentage, okay? So if I normally, they say 30%, right? The gross profit percentage is 30% on top of page 486. So if my sales price is $100, my cost must have been 70 because my gross profit is $30. Got the idea? It's 30%. So if something sold for 100, I'd get a 30% gross profit. That's all they're saying, okay? Obviously, my cost is 70%. Everybody agree? Just is. So what you do is you just do your inventory. In their example, their beginning inventory was 60, right? 60,000. Okay? And then their purchases is the beginning inventory. Their purchases for this period were 200,000. So if I was doing a cost of goods sold schedule, what would be available, everybody? 260. And of course, they have the beginning inventory is in the inventory account, the purchases is in the purchases account, but you can still analyze it like this, right? Okay, and what do I want to know? What's the ending inventory? And therefore, what's over here? Cost of goods sold, right? That's it, isn't it? That 260 has to be split somehow. How much do you think will be in each place? How would you know? I estimate my cost of goods sold, subtract it to get my ending inventory. Okay? Well, what if I know my sales are, what's their sales in this company? 280. And the way they calculate it is the strangest thing. They do the gross profit first. I wouldn't. I'd do the cost of goods sold first and then subtract and get the gross profit, maybe, I guess. But this is 70%, and that's my cost of goods sold. It's going to go right there, isn't it? What's 70% of the 280? 196? Yeah, it's under 96,000. I don't know why, but they take 30% of it instead. What's 30% of the 280? 84,000. And then they take the 84,000 away from the 280, and what do they get, of course? 196. Seems kind of convoluted to me. Would it have been more direct just to take 70% of the 280 and be done with it? Do it however you want. I could care less. That cost of goods sold is going to be in here. It'll be 196,000. So if you have 260 available and you sold off 196, what do you have for ending inventory? 64. That's all they're doing. Could you do these, you guys? Okay, now that's my estimate of ending inventory if I was doing an interim financial statement. But let's say that I go count the inventory after a fire, and the inventory I have left is 25,000. So when I count, so it's exactly the same scenario as this, right? I know what my purchases were, I know my beginning inventory, I know my purchases, therefore I know available, I know what my sales are, I know my cost of goods sold percentage, gross profit percentage, either one, right? Okay, if you know one, you know the other. Okay, so I think my cost of goods sold is 196. So I think before the fire I had 64,000 of inventory, right? Then I go count what I have after the fire. What did I say we had after the fire? 25. So I have 25,000 inventory left after the fire. Can you tell me what your loss was? Real common question. What'd you lose? You're supposed to have 64, and now you only have 25. What's missing? 29? 39. 39,000. Give me a journal entry for that. It's uninsured. Give me a journal entry. Oh, come on.
Yeah,
What do you want to do in inventory?
reduce.
I think I credit inventory. Wouldn't you guys? How much? Whoops, 39,000. Okay. All right? And debit. It's not an extraordinary item. It's not unusual and infrequent. We hope it's infrequent, but it's not unusual. Loss. Uninsured loss, maybe? Loss due to fire. Right? That'd be the debit, 39,000. Credit inventory. Wouldn't you? Actually, if you're using periodic, you go to income summary, but oh, okay, close it out through cost of goods sold. Okay, got it? This is easy, isn't it? Okay. So you can figure these, no problem. So now I guess I can't stall any longer. Let's take a look at what these methods are. Over on page 488 and thereafter. And the strange thing they did here is they put one of them back in the appendix. So appendix 9A, LIFO retail methods, is back there. So they've got a LIFO retail method, and then they have a dollar value LIFO retail method. Okay, so be sure and read the appendix. Be sure and do a bunch of problems. So let's go through real quick. I got 5 minutes then, I guess. No, I don't. It's time to leave it. Okay, 1 minute. What are the methods? What are they named? What are they named? Okay, we got retail inventory methods. I want you to get them all down. Okay, you use basically the same data to do them. Okay, so what do we have? One is called the conventional method, right? Okay. Conventional method, markups and markdowns. It's over on page 490, okay? It uses cost markups, but not markdowns. It's called the conventional inventory method, which is also called what? Lower of cost or market. Yeah, both. It's approximating lower of cost or market. And the huge difference here, you guys, is that you include the markups, but not the markdowns. As it says in that one sentence at the bottom of page 490 in bold. Okay, so it approximates lower of cost or market. Okay, and then we have one that is sort of an average, right? Which they just call the retail method. Okay, it's where you use both. Okay, so the big difference here is markups, no markdowns. So pay attention to that when you're studying this stuff for next time. Average, markups, and markdowns. What's a markup? From my normal sales price, I mark up. Right? What's a markdown? From my normal sales price, I mark down. Because what we're doing is retail method. What I'm going to do is I'm going to count my inventory and I'm going to price it at retail sales price. And then I'm going to take a cost percentage times it to estimate what the cost of the inventory is. So I'll have an estimated inventory and an estimated cost of goods sold. Who might do this? Retailers. On each bin in the store, used to be on each product, sometimes it still is, the price is right there, so you know what you're selling it for. You don't want to go look up all the costs. So this is the way you could estimate it. Got the idea? The inventory counters count the inventory, record what your sales price is, and you multiply your sales price times the inventory, and you get your whole inventory at retail. And then you value it, okay, at cost. Try to estimate cost. Okay, so those are two of them. And then when we go back to the appendix, what do we have? LIFO. So all of these are retail methods, okay? Now the difference with LIFO, we're still using both, by the way, markups and markdowns here. We don't have a lower cost or market one, although you could envision one if you wanted to. I don't know if anybody actually does that. Okay, but we separate the beginning inventory. Right? So we'll have a cost percentage in the beginning inventory, and then we'll have one for the purchases during the period. On the first two here, we combine the beginning inventory plus the purchases, and then get a cost of retail percentage. Okay? How many of you read this chapter? That's why a few people are shaking their heads. Yeah, that makes sense. And others are kind of, what the hell are you talking about? Read it carefully, okay? It is kind of confusing. Okay? Then there's one other one. Guess what it is? This one's really fun. Dollar value LIFO retail. Now again, all of these are retail methods, okay? then this one is where we don't want to keep track of each inventory, right? So we use dollar value, which we did in the last chapter, but now it's based on the retail. So we got another additional computation to make. Okay, so with the same data, you should be able to do any one of those four. Okay, this will be fun to get down. Okay, it'll be fun to get down. See you guys.